Terrific. Well, this is one of my favorite talk to do, actually, and thank you so much for having me on. It's I think in the market, obviously as traders, we're obviously looking for the thing that's going to give us the edge, or that extra bit of efficiency in finding the inefficiencies in the market. And so we call it the secret sauce. And essentially the secret sauce is looking for where those inefficiencies are and trying to capture them to give us the certain types of advantages the rest of the market doesn't see. Now, we are going to talk about some live situations here today and some of the trades that we're currently in. So please be aware that it is for educational purposes only and to take it in the context it's meant. But essentially, these extra factors that we're looking for are all around us. And you know, in today's economy, we're filled with lots of distractions. We've got stock twits, we've got Facebook, you've got the news, you've got the talking heads. You have so many things out there to distract you into different directions, and they're not all good. We need a way to quantify them and then put them into a process of how we're to determine if the information is useful or not. But once we've done that, we need to then figure out, is there some extra special factor that gives us the edge? And some of the ingredients that we look for, firstly, are things such as divergence. So what is it and how do we look for it? Now, a lot of people have been talked about divergence too, and they've learnt about types of divergence. But there's two types of analysis that you can do when looking at charts. And one is absolute analysis, which is where you're looking for, which is what most people are taught, which is where you're looking for what does the indicator say, or what does the information that I'm presented with today say, and in a yes-no type of approach. So in other words, is the RSI above 30? Buy. Is the stochastic breaking into an oversold situation? Sell. So we look at these kind of absolute values to give us yes-no responses. But what's far more powerful is looking at relative information. What is the information telling me relative to recently when the prices were at the same value and so forth? Okay, so we're going to have a look at that today, and what's the most powerful types of divergence we can see in the market, and how do we use it? We're going to be talking about the emotion in the market. So how do we read levels of emotion, and when are they getting to levels that dictate possible reversals? Now, of course, we saw the huge 300-point drop in the Dow on Friday, and this was highly predictable. So what we're going to talk about today is how you could have predicted that, and what's next. Insiders institutions, where do we find it? What information is meaningful? What does it mean? And the short float. What does the short float mean to the market, and where does that play into the special sauce that we're talking about today? So let's start with divergence. Basically, divergence, and it's a great quote that I love, is if the words don't add up, it's usually because the truth wasn't included in the equation. So divergence is where one piece of data tells a different story than the other. And in technical analysis, this is mostly commonly diagnosed in the format of price moving opposite to the direction of a correlating indicator. Now, a lot of the time when people learn divergence, so maybe who here is very familiar with divergence? Most people already working with this, or who is maybe new to the topic? Because most people, when they learn divergence, typically working with things like stochastics, maybe RSI. My favorite type of divergence is looking at price divergence versus money flow. Now, money flow is typically understood as a combination of several variables that truly identify an uptrend. So if you look at all the popular indicators that most people have on a chart, What are they? They have stochastics, which identifies whether the stock is closing new highs in the range. So is it making high closes in terms of its daily range day after day? The second type of popular indicator is directional movement. So directional movement is, are we making new highs or new lows? And another very popular indicator is on-balance volume, or in other words, as the stock increases, is the volume increasing with it? Okay, so all of these things are considered to be true signs of an uptrend. So when all three things are happening, it's assumed that the smart money is buying. And so one of the most valuable indicators I use for divergence or any kind of analysis is to look at is the smart money buying or not, as indicated by money flow. So you can do this using Chaikin money flow. You can do this using some other standard money flow indicators, but my favorite one is Twig's money flow, which is a slight kind of tweak to the Chaikin money flow system. And basically what it does is it combines all three things and puts it out as a value, as a percentage of accumulation or distribution. So how does this become valuable? Well, where this becomes valuable is if we can see that price is dropping sharply and decreasing and making new lows and so forth, however the money flow is going up or staying stable, then we have divergence. We have price dropping, which makes the public or retail trader feel that the situation is getting worse, but yet we see that the smart money is loading up or accumulating. So what we can then assume, or what we can start to think, is that the price drop is potentially therefore misleading and a reversal is about to occur. And of course divergence on the opposite side is where we can see price increasing with the smart money decreasing. And therefore we can assume that the price increase is therefore potentially misleading. So let's apply this to the common the markets right now. And I'm going to bring up my charts here. Okay, can everyone see the charts there up in front of you? And by the way, if you have any stocks that you're currently trading that you'd like to kind of apply this strategy to, feel free to throw them up. But let's look at the S&P 500. So for any of you following us on our YouTube channel, we posted a video on, what was it, I guess Thursday night, and we said we feel that the market is heading towards a top, that it's basically going to tip over. And one of the main reasons was, if you look at the way the S&P 500 had been building, you'll see that it was basically making equal highs across the tops. So in other words, price going to the same places, but what do you see in the money flow down the bottom? You can see that the money flow is dropping sharply. In other words, price staying the same, but money flow diverging. So when markets diverge, when money flow moves in opposite direction to price, what it's typically showing us is that the rallies that are occurring in the market are being used as selling opportunities rather than buying opportunities for the smart money. And that's when price doesn't truly show us what's really going on behind the scenes. And this is where money flow steps in and where divergence is key. Okay, so you can see that there. Let's go across to a couple of others here. Okay, so Tesla, or BTU I see as well. All right, let's have a look. It's coming from the audience. Okay, there's BTU. Okay, so you see BTU. Here's a great example again of divergence. You see the price declining sharply, and you see the money flow going up. And the great indication when the stock broke its resistance right here of a terrific short-term long position, where you could have gotten in around 665 and taken your position out when it met short-term resistance. And you see that reversal candle there, but that from 665 all the way up to a high there of 823, I think anyone would be happy with that type of result. Right, so you start to see where divergence on this stock would have been perfect. TSLA, look at that one as well, sure. Okay, again, great. Well, we've already been studying this a while for our students, but you'll see the divergence here also. In fact, a few different strategies combined here. If you go back and have a look, you can see the smart money reversal right there, sharp rally, pull back, and so we were looking at this support line as to where this down channel would end, where the smart money would step in, and you can see it happen right there around 185. And have a look at the smart money. What was the smart money doing? Higher lows, lower price, divergence. That's exactly what we're looking for. And right there and then, that's where that great rally happened up from 185 to 220, and where we've seen consolidation up here from afterwards. Now we'll come back and have a look at some more examples, but the divergence is really, really powerful when you're starting to look at it in terms of where the smart money is. Okay. Next. So why is this valuable? Because basically what the smart money is showing us is what the real story is versus the emotion in the market. So they're showing where retail traders versus the smart money are moving in opposite directions. Yes, what we were doing is we were using a daily chart before. I'm going to go back to that in a moment. But one of the key things that we want to see is when smart money and retail money depart each other. Because if you look at Dow theory, of course, that's the whole idea, is that there are three types of trading environments. There's the accumulation zone, where the smart money is getting in. Then there's the public participation zone, which is where everyone else starts to buy. And then there's the distribution zone, which is where basically smart money wants you to feel as excited as possible so that they can sell to you, they can get out. And that's obviously what we want to avoid. So just before we flip over to the next slide, one of the things that we need to do in terms of identifying where these periods of divergence start and end is having an understanding of where these trends become valuable. Where do we see, or where do we analyze one trend starting and another ending? And this comes back to what I was talking about earlier in terms of absolute and relative analysis. So if you're looking at this stock now, let's go to a new one. This is quite a volatile stock, good old Tesla. Let's have a look at one of the other ones from the audience, INCY. Okay. So you have a look at INCY, for example. The things that are important when you look at a chart like this is, firstly, what are we looking at in terms of absolute analysis? So in terms of absolute values, we look at the indicator and we say, what is the indicator telling us? Well, it's a money flow indicator. So having money flow above zero tells us that that there is accumulation. Okay, that we have higher highs, high closes in the range, increasing volume with price. Wonderful. The smart money is interested in the stock. So because the value is positive, the absolute answer that we get from the indicator is yes, it's positive. Buying is happening, or accumulation is happening. Now, then we look at it relatively, and we say, but how much buying compared to how much we would expect there to be? And that's when we look at this value. Okay? And so what you can see is the price has gone higher, but we are lower. But where do we measure from and to in terms of comparing the trend of that divergence? And that's important to understand. So when we look at INCY, we can see that we have made lower highs and lower lows since the recent peak. So just like any kind of trend, what you want to be looking for is where the trend changed and whether that's shifted since. So this is a current example, and as you can see in INCY, we're not in terrible sell territory, but we're certainly getting warning signs that this thing could be oversold, that this could be in trouble. Okay, so for me, this is where I would be updating my stop losses and looking for a protection, for example, underneath the high of that candle. So underneath $99 is where I would be setting my stop. There's a question about Netflix. Netflix is a terrific example of divergence. In fact, I'll take you back to the chart from last year. You can see the lines are still on that chart. This was something that we actually picked as an options during earnings play last year, and we saw. I'll take the lines off for a moment. Excellent example of what we're actually teaching you today. So Netflix was going sideways, and it was kind of in a contracting, almost head and shoulders pattern. So bouncing back and forth, went up, created this kind of awkward right shoulder, and then pulled back to this support line. And as it did, right there, you'll be able to see the money flow had diverged significantly to the downside. So as price made new highs and went up, you can see that the money flow made lower highs and lower lows. So where you measure the trend of divergence in money flow, where it starts and finishes, is just like a stock where it continues to make lower highs and lower lows from. So this entire trend of the money flow began here and continued to do that until it broke a new high over here on the right, which is of course where it started recovering. But here was the easy money. Here was the easy money, because as the stock went up into earnings, the smart money was selling off. And that's where we have recommended the $370 puts, which overnight profited 1,200%. The same kind of story actually around about the same time was IBM, another great example of this types of plays. So there's IBM, another options during earnings play. So IBM, you can see going up. There's the head. There's the right shoulder. So another head and shoulders pattern. And then as it went into earnings, you can see the stock making, in terms of its trend, higher highs and higher lows across the head and shoulders pattern. And as it came into its test point, what did the money flow show us? It showed us that as price had increased, money flow had made new lows. And again, this is comparative analysis or relative analysis. You can see that previously the stock had been here at $180. Money flow was negative 6%. Over on the right, the stock is $184, so a higher price. You therefore expect more money going in, or a higher level of smart money, but not the case. We were down at negative 18. So a 12% change to the downside in terms of its money flow. And again, we'll pull up some extra stocks here if people have questions towards the end. But is this good for inverse ETFs? Yes, absolutely. It's good for anything where money flows in and out. What does overbought and oversold mean? Overbought means that a stock has become emotional, and that the retail traders are buying into the hype, and the stock's potentially about to pull back. Oversold, of course, is the opposite, where selling has become emotional and the stock is due to rally. Okay, so we'll go back to the slide here because we've got a couple of other things to talk about. Okay, so we've been talking about the smart money and why that's powerful in looking for divergence, but obviously identifying the actual smart money that's taking place can also be very powerful, especially when we're dealing with options, when we're dealing with earnings season and so forth. So one of the websites I wanted to share with you today, which is very valuable, is something called Finviz. I'm sure many people in here have used Finviz before, but I'm also going to show you how to use it much more powerfully and how to add something extra, which is the Insider Cow research tool, to make it much more useful in terms of how we read that information that we get. So before we go into that, quick summary. Obviously, what are insiders institutions? Well, insiders are people that are working for the company. They're people that have inside information. Maybe they're the CEO, board of directors, things like that. Institutions are obviously those that are hedge funds, BlackRock, Vanguard, those kind of guys, where we're dealing with heavy money, the big boys at the table, so to speak, or girls. And of course also 10% owners. But the group can be summarized by those that know the stock the most intimately, those that have the details of what's really going on. And obviously it's illegal for people that know inside information to act on it, to take advantage of information that the rest of the public market don't have. But it happens all the time. If there was a white collar crime show, for a cops version, if you want to put it that way, of people running into boardrooms and pulling people out by their neckties, we'd see a whole different type of TV show. It happens all the time. But just because it's not legal doesn't mean that we can't detect when perhaps someone is acting on information that is there. So that is not illegal. So looking for where big money is flowing, when something is going on, perhaps, is a big secret sauce ingredient. So how do we find this information? What information is relevant versus just normal insider buying or selling? And how do we know if their track record is relevant? How do we know what the importance of different people's individual buying and selling habits are? So let's start with Finviz. Now, has anyone here not used Finviz before? Has anyone not used Finviz before? Okay. So let's have a look at Finviz. You should see it up on your screen now. So I'm logged into the elite version, but you don't need to have a subscription to use this tool. It's a free online available tool. So just finviz.com, and what you can do is you can see heat maps of where the market's going and some excellent tools that you can kind of browse through. Today we're going to concentrate on the insider section and the screener section. So firstly, let's just have a look at the insider section. Now, once again, just looking at the money flow divergence, I've already talked to you about why the big drop in the market Friday was highly predictable. In fact, again, those of you who follow our YouTube videos, our executive summaries we publish each night, you'll know that we've had basically 4 to 5 longs almost every day that we've been finding that have performed extremely well. A lot of flag formations, a lot of longs. All of a sudden, Thursday, Wednesday, they all turned into good shorts. And one of the things that, apart from looking at that divergence in the money flow, that tuned me into this potentially upcoming drop or vacuum of buyers, was the fact that when I went into the insider trading, all I was seeing was sells. So you can see the sells here, the latest insider selling, all red, with a couple of blues, right? Let's go to top insider trading, right? So this is the largest transactions of the largest companies. What do you see? Not just yesterday, but the entire week. Sell, 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 the whole way through. So, I see a comment, it is red because it is their paycheck. That's right. Exactly. And of course the top 10% of trading, this is updated daily, BJ, and there's your top 10%. So what you start to see is you start to see that the smart money, as indicated now by just the individual transactions, is to get out, right? To get out. That you see a big exodus. And what you don't see is buying. And that's the scary part. Because yes, selling can happen for a lot of reasons. They might sell for tax loss reasons. They might sell because perhaps their daughter's going traveling around the world and needs a budget. People might sell for a number of reasons. But not buying is also an action, right? The lack of buying, the lack of spending on their own companies is a sign as well. So when you start to see this number one, just on its own, can be very useful to look for possible opportunities. Right, shorting opportunities, long opportunities. But just going through and scrolling your mouse over, and this is where your technical analysis skills will come into play, and looking for, what's a good-looking, technically good-looking chart. Okay. Now, as we go over to the screener, this is where that information can become more powerful. So let's bring up the screen here. Okay, so you've got that on the screen. So we've got descriptive, fundamental, technical, and all. So we're going to click on all, so we have all the information in front of us. So what we can now do is we can start saying, all right, let's program the secret sauce into the scan. So you can see here on the right-hand side, we have two boxes, one that says insider transactions and one that says institutional transactions. So we go insider transactions, negative. Institutional transactions, negative. So basically there are, by looking for stocks that have negative selling and institutional and insider on both the same scale, we get 723 stocks. Now let's say that we then wanted to combine that with earnings. So where are the stocks where the companies are selling their own stock and the institutions are as well before earnings are announced? So we can go to earnings date next week. All right, so we have 132 stocks where there's insider selling, institutional selling with earnings coming up. And what we could now do is we could also further qualify this by saying a high P to E ratio, or anything really. Because what we've now built is we built an idea of when the big money is stepping out before the potential of a big surprise. And the smart money knows their stock best than anyone. So what you have to look at when you're thinking about insider transactions isn't just what they're doing says, but also what they're not doing says. So in other words, if you own a healthcare stock, if you own a large portion of a healthcare stock and you are the CEO or CFO or the operations director, and you're about 2 weeks away from earnings or some kind of announcement that was supposed to be very positive, and you knew that as an insider, you knew that the quarter was great. What would you not do? You wouldn't sell. You would not sell, even if it was within your appropriate window, if you had a fair degree of confidence the stock was about to gap up 20% 3 weeks later. You wouldn't do it. I don't know who would, right? So any kind of selling, especially if it's broad-based, is meaningful if a company has a lot of potential. So one of the further qualifiers that I like to add to this type of scan is the P/E ratio. So we can look for negative and negative with earnings next week, and then start to say, let's also have a high P/E ratio, because these are the companies that are speculated to have the most earning potential. Because if you're selling at a 100 P/E ratio, what does that mean? It means that, like, if somebody came to me and said, hey John, I want to buy your carpet cleaning business. How much do you make? I said, well, we make $1 million a year. They said, okay John, how much do you want for the business? I'd like 100 million, please. That would seem extortionately high, wouldn't it? To charge someone $100 million for a company that only makes $1 million a year, because that would take 100 years to make back the investment. And that's what a P/E ratio tells us. What is the price of the company versus what it's earning? Price to earnings ratio. So the only way you can justify charging 100 times what the company currently makes is if the company is anticipated to make significantly more, because I own the patent on the magic spray that makes any stain go away instantly. So John's carpet cleaning business all of a sudden becomes significantly more valuable than what it's currently doing. And that's where the multiples increase. Now, if John had the magic spray, what you wouldn't expect is to see John selling off his shares in that company ahead of that magic spray being released. And so when we have a high P/E ratio, but we see that combined with insider transaction selling and institutional transaction selling, it's a little bit suspicious. It certainly doesn't invoke confidence. So this is where we can now start to, again, roll our mouse over and start to see the charts. Or better still, simply click on Basic, and we'll now see the information on the different companies with the earnings date, short float, insider transactions, institutional transactions. You can see all that information starting to come up on the right-hand side, as well as a quick snapshot of the chart. So immediately, this is again where your technical analysis skills come into play. We can see that we have broken down out of an up channel, which we know generally revert to the opposite direction. So now we have a bearish chart. We have, again, a breakdown here on eBay, bearish chart. We have a stock approaching smart money support, sharp reversal area. That's going to be dangerous. I'd probably avoid that. But what we're basically looking for is we're scanning the charts, now looking for something that's technically weak. So let's look at the first one as an example, ABAX. We have a high P/E ratio. We have earnings April 23rd aftermarket, and we can see that we're around the analyst target price of 64.50. So what we can do here is we can now investigate this further. Now I see a couple of questions. Can you look at the Dow Jones 30 with us? Yes, we can bring that up. What does negative insiders transactions mean? Negative means selling or no selling. Negative insider transactions means selling. Isn't selling by management before earnings insider trading? It can be, yes. There are certain rules as to when you can sell and when you can't, and so depending on what type of announcement's coming up, but doesn't mean that the rules are always followed. And what we can do to look at these types of individual transactions is we can go into another site that I really like, which people aren't necessarily that familiar with, which is Insider Cow. Okay, there we go, Insider Cow. Now what we can do here is we can go in and say, well, what has been going on? How important are these transactions? Or in the context of our slide before, what information is relevant and what is the track record of its importance? So we go back to Insider Cow. What we can do is we can type in ABAX, and you'll see it then gives us a reading of what's going on. Okay? You can see all of these transactions are listed on the left-hand side. So we've had heavy insider selling in December. Well, actually not that heavy, mostly back in November. You can see by the director, officer, president, CEO, and board chairman. And it's kind of almost like they're taking turns month after month as you look down the transaction size. Okay, we can also see where they sold at in terms of price. So the price is currently at $62.29. So when we see what information is relevant, one of the first things we look at is the date, but what we also want to look at is the price. What price did they sell at? Because that's essentially how they're valuing their company. And you can see that they were all selling between $53 and $60. So they're valuing their company at that price. That's what they will accept for a sell point. So as we look at ABAX now on the chart, we can see how that's moved since those sell points, since November. And you can see essentially it's just kept going up. So as the smart money has gone, as the stock has gone up, you can see that the smart money has been selling. And as you look into the money flow indicator, you can see that that was already telling us that that was the case. You can see that the smart money indicator was already telling us that it was getting out. Because as price has gone higher, we have that divergence that we looked for before. And I'm just looking at a live example. Obviously this wasn't pre-planned, but you can see how those are both lining up with each other. Now the other thing you can do is we can look at, so we look at the price. Is the stock still close to the price that they've sold at? The date, is the date still relevant? And the last thing we can look at is we can look at institutional transactions, and we can actually see if they are buying or selling as well. Now here we've got a bit of a mixed bag, so one kind of is cancelling the other out. But this is also very valuable to look at in terms of seeing if you get that perfect storm where buying and selling is occurring. Last but not least, track record. So one thing you can also do, which I find very, very interesting, is to go in and look at the individuals that are actually buying or selling the stock and pull up their track record. So we can see that Mr. Clinton Seville sold off a fair chunk. So maybe we want to go in and see how precise Clinton or Mr. Seville has been in predicting some good moves before. So we can just simply click on his name and we can actually see all of the insider transactions that Mr. Seville has done over the years. And we can look at how on point those transactions have been. So where this type of research has been very, very useful is in trades such as ATRA. Now this is, for those of you who follow us on YouTube, will remember this is one that we picked way back when on February 17th. And we said that this is one of my favorite patterns to possibly trade, which is a bump and run formation, which is where you get a down channel followed by a 66-degree or more drop, consolidation at the bottom, and then kind of like a spoon, like a little rally up. And so on Tuesday, February 17th, we said, right, we expect this because it's one of out of 100 rankings, this ranks number 5 from a 1 to 100 scale. This is the number 5 out of 100 in terms of performance and profitability. So whenever we see this, we get very excited. So we said, yes, look, we're very confident this should go up to the top of the channel as a bump and run would dictate and hit that $22.20 price. And it did. And that's where we got out. And we then suggested a re-entry when it did the bump, which is down, back down to $20 to re-enter at 20 ahead of the run. And it did, and it ran strong. It then created a flag formation, which dictated it should go even higher, which it did. And unfortunately, that's where I got out. I got out at 39. But from 20 to 39, this was an excellent and easy trade. And you can see the money flow, as the stock was dropping, that money flow was going up. And certainly as it started to perform the pattern, up much more significantly. What was really interesting, however, was the smart money. And if we just go back and look up ATRA, you can see that the smart money was buying it, and all people across the board were buying it in large quantities ahead of this even happening. What was even more interesting was the institutions. Now you may notice that just before, I said we picked this on February 18th, look what happened on February 17th. You have all of that buying, big money. And most importantly, you can see Carlos Slim, one of the wealthiest men in North America, loading up. And of course, we're talking about one of the most wealthiest men in Mexico. And I've just spent 3 months in Mexico. And I tell you, things aren't always what they seem. It's a little bit dodgy. So when you see somebody that owns the biggest companies and making the most money in a very politically unstable country, you kind of wonder what he might know that others don't. And when he loads up ahead of a stock going from 20 to 40, I'm going to load up with him.
Hey, John,
So
I don't mean to interrupt, but we do have about a minute, 2 minutes left.
Yep, all good. Thank you very much, Reed. So let me bring this to a summary. Putting all these special pieces of ingredients together is where we see the greatest value or the greatest edge in the trades. And but you need to have that understanding of putting those pieces together. And so one of the things I wanted to leave you with tonight or today is the idea of building your knowledge up to a point that you can make this a complete puzzle. So the Ultimate Trader's Toolbox is a course we launched just this year. It took us most of last year to put together, and it's one of our most popular courses that we're currently offering. Basically, in the first module, and there's 5 modules for a total of $97, we'll go over everything that introduces you to how the high-frequency traders work and what algorithmic trading is all about. We'll go through the frequently asked questions of new traders and how to basically start trading efficiently versus putting a lot of time into it. Module 2 is where we go over market cycles, oscillation, consolidation, and momentum, very important stuff that you need to understand, and how to look at where the smart money is going. Module 3 is where we look at the DNA and the blueprint of the market and how to read candlestick and bar charts to essentially see what is happening in the chart rather than following just pure indicator analysis. And Module 4 is where we go into the advanced techniques of that and get into like some more powerful candlestick formations and how they play into the model. And then my favorite module of all, and the last module, which is scanning. And that's where we take everything you've learned in the first 4 modules, which is, it's about a 10-hour course altogether. And once we've gone through all of that, then we show you how to build scans to find exactly what we're looking for. And that's where the smart money is incorporated. That's where much, much more advanced scans than what I showed you today start working, and where we put it all together. I'm out of time for today, but it's an amazing course, and you can, if you do have any questions that I haven't been able to answer today, please feel free to forward them to us. But what we're doing is a special event for the MTI today as a thank you, is we're also incorporating, for the first 50 people that do register, you'll also be assigned your own personal coach for one-on-one support and training while you go through the course. So we're limiting that to 50 people. And if you do have any questions, please do email us or give us a call, and we'd be more than happy to get you started. And there's a link down the bottom. So with that, mate, thank you so much for all the questions. It's been a wonderful show my afternoon with you, and I'll pass it back over to Reed.